Hi, Chris Hasenberg here from Hasenberg Financial Group with an estate planning educational seminar that we like to call The Secrets of Estate Preservation. In today's video, I'm going to introduce you to our firm and tell you a little bit about myself. We're going to talk about probate and how probate works and ways to avoid probate. We're going to talk about wills and trusts and the different types of wills and trusts. Taxes, all the different types of taxes, and of course taxes are a big deal. And our exposure to risk to nursing homes and long-term care. At the very end of this video, we'll show you ways that you can get an absolutely free consultation to discuss any of these different topics. Here's a friend of mine. She got pulled over for a traffic violation. And when the police officer came up to the window and asked for her driver's license, she handed him her driver's license along with her concealed carry license and said, "Just so you know, officer, I have a small pistol that I keep in my purse." Because that's what you're supposed to do. And the officer thanked her for that, and he said, "Well, also, to be fair, to let you know, officer, I also have a .357 I keep in the console between the seats. I keep a .44 Magnum in the glove box of my, and I also keep a shotgun in the trunk." And the police officer, of course, said back and said, "Ma'am, what are you so afraid of, or who are you so afraid of?" And she said, "Absolutely nobody." So the question is, what brought you here? What brought you here to watch this video today? Is it the idea that you might leave a big mess to your family? Is it an idea that maybe the government or the IRS is going to be a larger beneficiary to your accounts than your heirs? And so on. And so the question is one of the things that we found in working through this and talking about these different areas is most people's largest concerns is, do I have enough? And what can go wrong along the way? And so our mission here at Hasenberg Financial Group is to give you financial guidance to help you enjoy life more and worry less. And so if in going through this video that happens, then I know that we've definitely, it was time well spent. Our main office is in Eau Claire, Wisconsin, and it's 431 East Claremont. And if you're familiar with Eau Claire, it's about halfway in between the Memorial High School and the hospital, Sacred Heart, and in Putnam Heights, or in Putnam Strip, and it's about halfway in between on the south side of Claremont. And the building is pretty easy to recognize. It's the one that's got 3 white pillars, so it's not too hard to find. A little bit about myself. I live up on Lake Wissota, up in Chippewa Falls, and I do have a graduate certificate in financial planning from the University of Georgia. I graduated from UW Stout over in Menominee, Wisconsin. I went to a high school just south of River Falls called Ellsworth High School, and I grew up in a little town called Hager City, Wisconsin. Largely, it's 4 or 5 bars and a church, and so on. It's right across the river from Red Wing, Minnesota. I do have my Series 7 stock brokerage license, so I'm licensed to sell individual stocks and mutual funds and so on. But the one we're most proud of is our licensing is the Series 66. That means that we are a registered investment advisor and we are covered under our corporate RIA. And that means that we, as a firm, are legally obligated to give you advice that's in your best interest. And that's a fiduciary standard that we are proud that we abide by. We have our insurance licensing here, and the insurance licensing is in the area of life and health, long-term care, annuities, and so on. Not currently licensed in auto and homeowners insurance, but we definitely have opinions on the types of and amounts of coverages to have in those areas. I am the owner of Hasenberg Financial Group, and we've been here since March of 1994. Yes, a long time. And just after we had started in 1995, for a few years, I had created a business called Estate Organizational Services. And what that was I did seminars, and I would charge a fee for the seminar. And then after seminars, I would also charge an hourly fee to come to your homes and help people organize their stuff. And what I found by not charging fees for seminars and so on is that more of you attended. And so yes, this video is absolutely free, and we hope that you get a lot of information from it. Before that, I was working at IDS Financial Services starting in 1992, and I was there for a year and a half or so. And IDS turned into American Express or Ameriprise and so on. That all changed after I left and so on. I am a member of the Academy of Preferred Financial Advisors out of Los Angeles, California. I'm also a member of Peak Advisor Alliance out of Omaha, Nebraska. I've been a coordinator for Dave Ramsey's Financial Peace University in the past. And my family. I'm married to my wife Julie, and I have 3 children. She has 4. We got 5 of them with college degrees and out of the home, and we have 1 left at the house and so on. And I like to hunt, fish, golf, and play racquetball. Those are some of my hobbies and interests. And so, enough about me. I've been doing public seminars on this topic 4 or 5 times a year for 20 plus years. And in doing that, we offer these free consultations, and meeting with you, we found that most everybody has a common set of goals that they're trying to accomplish. One of those goals may be to make sure that if something happens to you, that your estate is distributed according to your desires, not the court's. Another goal is we may want to avoid as much as we can in taxes, especially after our death, but even during our lifetime, and make sure that the different types of taxes that we can reduce, income taxes, gift taxes, capital gains, all different types of taxes. Another goal is to avoid probate, again, during our life and after death. Another common goal that a lot of you may have is that you want to have your loved ones make medical and financial decisions if you cannot. Protecting assets from a nursing home and long-term care facility, of course, is a big deal, and making sure that you keep your family and financial matters private. These are common goals that most people have, and I've only listed 6 of them here. You might have more than that. You might have only 1 of these or 2 of these, but if any of these are your goals, I feel that this video will definitely be worth your time to watch. Estate planning. What is an estate plan? An estate plan largely is a map. It's a map that reflects how you want your personal and financial affairs handled in the case of your incapacity or at death. And who needs an estate plan? Chances are you do. Everybody needs some sort of estate plan, and they're not just for the wealthy, because without a plan you can't control what happens to your property and so on. And in fact, an estate plan could definitely make a big difference in making your wishes clear and reducing family disputes. Proper estate planning can definitely go to providing assets for loved ones and so on, but estate plan is especially important if your spouse isn't comfortable with finances. Oftentimes we see in a marital relationship that one of the spouses handles the finances, and if something happened to that one, the survivor, who may not be as comfortable with finances, is left with a large burden. So being organized and being prepared for your spouse, if you are the primary financial person in the house, is super important. If you have children who are under the age of 18, or if you are responsible for children, there's a lot of grandparents raising grandkids now and so on, it is especially important to have a plan for them. If your net worth exceeds $11.58 million, that gets into some estate tax complications, and so it's especially important for you to have an estate plan. Owning property in more than one state can add a level of complexity to your estate plan that again it makes it more important. Keeping your family and financial matters private, if that's a concern, isn't it funny? We go our whole life. We don't tell anybody how much money we make. We don't tell anybody how much money we have. We don't tell anybody what we do with it. And without a proper estate planning, all of your finances become possibly public record. So we're going to show ways to avoid or reduce that opportunity for others to take advantage of. And here's the thing, is that business owners have an entire set of responsibilities that they have to address, including business continuation and what happens from here and so on. So, in its simplest form, estate planning really does come down to looking like a map. And that map is really largely broken into two areas. One is planning for your incapacity, or while you're alive, and two is after death. Now, while you're alive, it really comes down to two areas. One is your health care and your physical self, and two is your property, your stuff, your money, your assets, and so on. While you're alive, if you can't make decisions, we have to work with those areas. After death, it does get a little bit more complicated because we have to deal with wills and probate. We have to deal with taxes. We get into gifting and whether or not we should, or how the gifting has been affected in the past. We get into trusts and life insurances. And so what we're going to do today is work our way down this map and go through all of these different areas for you. Incapacity, or the inability to make decisions for yourself. What's the first thing that pops into your mind when you think of incapacity? Is it Alzheimer's? Is it dementia? Is it the inability to make decisions of that nature? And can I tell you that, yes, that is incapacity, but incapacity can strike at anyone at any time. In fact, I was one of those parents that received that phone call that no parent ever wants to get, and that was that your 17-year-old son was just in a car accident. And of course, when I was on the phone with the EMT and the paramedics and so on, they were able, because he was 17 years old, to tell me his condition and what's happening and so on, and it was all right. Now, the driver of his vehicle was 18 years old. Being over the age of 18 and not having proper planning, his parents weren't allowed to have that amount of information because of HIPAA laws and so on. In fact, they said, basically, he was in an accident, you have to come to the hospital. Now, fortunately, the boys have both survived and everything, and they've turned out great and so on. But it just goes to show that incapacity can happen to anyone at any time. And failing to plan for this means that the court has to appoint a guardian. If you don't have written documentation on who should plan for incapacity, you have to go through a court process, which involves attorneys and a guardian ad litem and all these different things. And this is a very expensive process. I've seen this as upwards to $2,000 or even $3,000 to go through this court process just because of improper planning on your part. Lack of planning, of course, can increase burden on the guardian, and if you don't have proper planning, the guardian might not even be the person that you would have picked for yourself. So, what do we do? Well, when we're dealing with your health care, there's a few different documents and things that we like to talk about. One is a living will, and two is a durable power of attorney for health care. Now, if you've ever been in a hospital and you were going to go under a surgical procedure, the doctors probably asked if while you were under anesthesia, if we have questions or decisions that need to be made, who can make those decisions for you while you're under? And you may have signed a document saying allow your spouse or allow your child or someone to make these decisions for you because you're under anesthesia. Well, that power of attorney is great, and that may work for that hospital or for that particular procedure, but a more all-encompassing one is a durable power of attorney for healthcare. And we recommend that everyone should have one of these. In fact, my son, just after his 18th birthday, signed a durable power of attorney allowing the physicians to talk to us about his health and so on. And so here's the thing, everyone should have one of these, and they're very easy to find. You can get them at the Department of Aging. You can Google Wisconsin POA and print off a healthcare power of attorney and fill it out. And it says, if you can't make decisions, this person can. And if this person is unable or unwilling, this person can. And then you have that witnessed and so on. And so a durable power of attorney for healthcare is an extremely important one. And the do not resuscitate part of this basically says, keep me alive by machines or pull the plug. These are, for lack of better terms, and so on. So this is planning for incapacity for your healthcare. When it comes to dealing with your assets, your money, your property, this gets a bit more complicated. One of the ways that people do this is through the use of joint ownership. And joint ownership is a great way of dealing with this. One of the things that we've seen is for example, if you have a joint account with your daughter, for example, because your daughter helps you with your bills and she's writing out checks and doing all of this stuff and helping you and so on. That is a way of handling that. However, because your daughter is a joint owner on that account, if your daughter was to get sued or divorced, even though she didn't put the assets in that account, the fact she's a joint ownership means that those assets could be counted against her in the event of a lawsuit or a divorce. And so here's the thing, is joint ownership is one way of handling incapacity, but it's not always the best way. A better way of handling it is through the use of a durable power of attorney. This durable power of attorney is a document that basically says if you can't make decisions, this person can. And if this person is unable or unwilling, listing out a second person or even a third person. And this durable power of attorney is something that I highly recommend getting professional help putting together. Meaning, you can go to Google and you can print one of these out and so on. But be careful, because if you fill this out wrong and you don't have the right I's dotted and the right T's crossed, you might be giving the power to make control of your finances on everything that you've accumulated to the wrong person at the wrong time. And so here's the thing, is I could cut my own hair. I could. But I don't. I pay Amy to cut my hair because Amy works with hair every day and she can see things that I can't see. There are times to be frugal, and there are times where it's an okay investment. This is one of those times. When you are looking at possibly giving the power of working with your assets that you've accumulated over your entire life, I highly recommend having an attorney prepare this. And again, I've seen this done for, it's not even that expensive. I've seen it done for $100. Some attorneys may charge a little less, some charge more, and so on. But having a durable power of attorney for healthcare is so important. Everyone should have one of these. And another way of planning for incapacity is through living trusts, and a living trust has you as the trustee, and maybe if you're married, a successor or a joint trustee, and then it can also set up successor trustees if something happens to you and so on. We'll talk more about trusts when we get into the death estate planning and so on. But one of the questions that comes up oftentimes is, who is the best person to be my power of attorneys? Couple things to keep in mind. One, if you've got a daughter who's an RN and a son who's an accountant, it is perfectly acceptable to let your RN daughter be the healthcare power of attorney and have your accountant son be the financial power of attorney. That's a good option. But also take into account geography. If you've got one kid who lives only a couple miles from you and you've got another one who lives on the other side of the country, obviously it's considerably easier for the local one to check your mailbox and look for your visa bill and help you with your day-to-day financial tasks and so on than it is the child on the other side of the country. But if the local child spends more time at the casino than they do with you, you may not want them to be your financial power of attorney, so kind of keep those sort of things into consideration also. So, now what happens if you pass away? Well, without an estate plan, some of your assets pass automatically. If you have joint ownership on a joint checking account with your spouse, for example, and if you pass away, your spouse walks into the bank with the death certificate and they change the ownership from a joint account to an individual account. That happens automatically. If you ever bought life insurance, that life insurance policy, probably the agent says, if you die, who gets this money? And they place that name into what's called a beneficiary, and so on. And in fact, these beneficiaries avoid probate. If you pass away, it goes directly to that person. And you could place beneficiaries on retirement accounts, IRAs, 401ks, 457 plans, Roth IRAs, deferred comps, all these different types of plans, 403bs. Again, you can place beneficiary designations and that happens automatically. But most everything else, if it isn't jointly owned or doesn't have a beneficiary, all goes through probate. And it passes according to state laws. Yes, the state of Wisconsin, for example, has a lineage of who these assets should go to. If you're married, it would automatically go to your spouse. If you don't have a spouse and you have children, it would go and split to your kids. And if you don't have children, it would go to your parents if they're still alive. And if they aren't alive, it would go to your siblings and so on, and nieces and nephews. There's a whole lineage of things. This is what happens if you die without an estate plan. Now, I'm going to talk about probate because that's what we are describing there, and I'm going to share with you the mechanics of probate. Don't make a bunch of notes on this because I'm going to share with you how probate works so you can understand how important it is to avoid going through probate and so on. So, the mechanics of probate is a petition is filed in probate court, then notices are published in the newspaper, a hearing is held before the probate court, the will is approved, a personal representative is appointed, creditors are notified. Here's an interesting one. We have to tell everyone that your heirs have to tell everyone that you owe money to that you've passed away. Do you have a list of everyone that you owe money to or that you have credit lines with? Do you have a list of your credit cards? Do you have a list of who your mortgage is with and so on? Do you have a list of personal loans? Having a list and being organized is super important part of your estate plan because the creditors have to be notified. After that, assets are appraised. Yes, and there are times where we got to have things appraised, and there are a lot of tax ramifications of this. And so, for example, there might be, to me, this old chair. To me, it's just an old chair. It's worthless to me, but to someone else, it might be an heirloom that came over on the mothership, and it's a super expensive antique and so on. Different things, same things have different values. I mean, you might have some land. It's unbuildable. It's a swamp for the most part, and maybe it's $1,000 an acre. And then you get a picture of Forky the Buck walking across the land, and all of a sudden now it's $2,500 an acre, and it's a very different value based on the fact that it's hunting or recreational land. And so my whole point is that different pieces of property or similar pieces of property can have different values, and there are a lot of tax ramifications of that. An inventory of assets are prepared and filed. And the operative word is filed. Now, as exciting as this video is, after this video is done, what I recommend, take a notepad and write down everything that you own. Now, that doesn't seem like a lot of fun. The only way it would be worse is if your heirs had to take that notepad and write down everything that you owned. All right, that would be no fun, obviously. And then, again, it's filed. It becomes public record. After that, annual accountings are filed. Attorneys get paid if the attorneys are involved in this. Estate taxes, if applicable, are paid. Income taxes, which are applicable a lot of times, are paid. Creditors then get paid. The personal representative who put you through this process is probably going to want some pay. And then whatever is left is distributed to your family. Isn't it interesting that, I think it's interesting that the attorneys get paid before the government. I kind of see who makes the rules and so on. Anyway, this is the mechanics of probate and so on. Now, a big misconception that people have is that a will avoids probate. It does not. In fact, the definition of a will is to tell probate court what to do with your stuff. Now, a will is the cornerstone of an estate plan. In fact, it directs how your property should be distributed, and it'll pick out who the executor should be and so on. And this is a document, again, we recommend everyone should have, but it can be very time consuming. I've found on average in Chippewa and Eau Claire counties, probably averaging around 13 months plus or minus. I've seen it as short as 6 weeks and as long as 10 years and counting. And so my whole point is that probate is expensive, but most people, it can be expensive and time consuming, but most people think their will take care of things, and it just simply will not. The definition, again, is to tell probate court what to do with your stuff. So what can we do to avoid probate? Now, there are lots of different ways of avoiding probate. In fact, one way of avoiding probate is through joint ownership. Again, I had mentioned earlier that if you and your spouse have a joint checking account, either of you can write checks, you have access to it and so on. If one of you passes away, the survivor can go into the bank with a death certificate and they change the ownership from 2 of you to 1 and so on. So again, that would be a way of avoiding probate. But I also shared with you why you don't want to leave it with one of your kids and just say split it with your siblings, because that's not a good thing to do, and so on. Another way of avoiding probate is through beneficiaries. And like I mentioned earlier with the life insurance, when you pass away, the insurance agent says who gets this money, and that's the primary beneficiary. If you're married, you probably picked them. And then take a look at your old insurance policies. Look in the back of the policy. After primary beneficiary, there's what's called a contingent beneficiary. Now you have to be careful with this, because if your old insurance policy says children split evenly, that can be a problem, because the insurance company doesn't know how many kids you have. In fact, your spouse might not even know how many kids you have. So here's the point, is the contingent beneficiary is a very important tool. And I highly recommend, if you're using contingent beneficiaries, list your heirs' names, birth dates, and social security numbers. Yes, their social security numbers, because if you think about it, it's a financial transaction if you're passing between a company and a person. And if they can share tax ID numbers, this whole thing becomes considerably simpler. Now, these contingent beneficiaries, yes, they can go on your life insurances, but they can also go on all of your your retirement plans, IRAs, 401ks, 403bs, and so on. You can place beneficiaries on your insurances and your annuities. And so this beneficiary is designed to avoid probate. Brokerage accounts. You can place what's called a TOD on a brokerage account, and that stands for transfer on death. Now, these brokerage accounts are things that you would have that might hold individual stocks or mutual funds that are non-retirement accounts and so on. And a TOD is an important document. It works just like one of the beneficiaries on your retirement accounts. Bank accounts. Yes, you can place what's called a POD on your bank accounts, which stands for payable on death. And why the banking industry and the financial industry can't get their acronyms together and call them a common thing is, to be desired. But my point is that it does avoid probate. You can avoid probate with your bank accounts. And so avoiding probate with individual investments, stocks, and so on, and avoiding bank accounts and retirement accounts are all great things. Another way to avoid probate is by giving your stuff away. While you're alive, if you gift money away, it's not there when you pass away. Now, the neat part about giving assets to your heirs is you see what they do with the money. But a possible downside of giving money to your heirs is you see what they do with the money. I mean, experience shows me that if you do give money, do it without strings, because if you give money to your son and your daughter-in-law shows up at your Thanksgiving dinner and she's got a super expensive purse that you would never have spent that much, it might be an awkward Thanksgiving dinner and so on. So my point is that one way of avoiding probate is giving stuff away, but again, be careful with that, because you want to, like I said, probably do it without strings is my experience, a better way to go. A trust is designed to avoid probate, and we're going to talk about how trusts work in just a minute, and again, it's written instructions showing how to avoid probate and so on. Now, I want to pause for a minute and explain that all of this information that I'm giving you is simply information. Do not act on anything that I'm telling you without getting proper guidance. And what I mean by that is if you have one child, for example, and you want all of your assets to go to this one person, utilizing these beneficiaries, TODs and PODs is a great tool a lot of times, because it's simple and easy. But if you've got 6 children, for example, and one of those 6 children has fallen out of favor with you and your family, well, it might be easier to have all of your assets go into a trust, all of your beneficiaries, and so everything be left and owned by a trust, so that when that 6th child, if that one does ever come back into the family fold, you simply have to change one document. You don't have to go to all of your different estate plan or investment plans, insurance agents, and banks, and makes all of these changes and so on. And again, if you have a lot of kids and one of them passes away before you, heaven forbid, well, just changing one document sometimes is considerably easier than having to go through all this. So my whole point is that all that I'm giving you today is information. Do not act on that without professional guidance. Moving forward, a big thing, especially here in Wisconsin, that you can avoid probate with is your real estate. Yes, you can avoid probate with real estate with I call it a beneficiary on real estate. It's also called a transfer on death deed. Now, this is something that's super important. If you've got, let's say you have husband and wife that own the house, and you've got two heirs, and you could place the beneficiary of the house to the two kids, and that of course is it's filed with the courthouse, and so mom and dad pass away, the two kids literally walk into the courthouse with two death certificates, and they change the ownership from the parents to them, and now they own it. They can hire a realtor, sell it, split the proceeds, and we just avoided probate. Now, why haven't you heard of a beneficiary on real estate? My feeling is that not a lot of people get paid to promote this. Meaning attorneys that charge $2,000 to $6,000, $8,000, $10,000 for a trust, they can make money doing that. And you've all probably heard of revocable living trusts. But a beneficiary on real estate is largely a $100 document, maybe a $30 court filing fee, and so on. No one really makes any money doing it, which is why you probably haven't heard of it before. And so, if you can avoid probate with your bank accounts, your insurances, your investment accounts, your retirement accounts, and your home, what's left? Maybe it's just vehicles and belongings and so on. And so these are different ways of avoiding probate. Now, trusts. I mentioned revocable trusts or trusts. The best way to think about a trust is it's largely just another type of ownership. Meaning, I have my individual account, my wife has an individual account, and we have a joint account. Those are three different types of ownership. A trust can be looked at as a lot of times a fourth type of ownership. And a trust is a very versatile planning tool and so on, and it can protect you in a lot of different areas. And trusts have some really good points to them and so on. And there are times where it makes a ton of sense, and there are times that maybe you're been sold something that you probably could have done in a lot less expensive way. And so on. So here's the thing: is there are many different types of wills and trusts. So I'm gonna simplify and bring it down to a handful, and that is one of those is what we call the basic will, or the I love you will. I call it a honey I love you. If I die, I love you. You get it all. It's a simple, easy document and so on. We recommend that everybody have one of these, just in case there are things that you couldn't avoid probate with automatically. A will with a contingent trust, and these trusts usually have a couple places in mind. One is if you're responsible for minors, making sure that assets are funneled into the trust, and that those assets, the trust would say who the guardians of the minors should be, and successors to those if they are unable or unwilling, and a trustee on who should manage the money. And they don't always make sense they make sense a lot of times to be different people, and so on. But if you've got a child who's receiving government benefits, and if they receive an inheritance from you, they might lose those benefits. So there's what's called special needs trusts and so on. If you've got a child who's a spendthrift, and you know if they inherit money, they're going to blow it, maybe it makes sense to leave assets into a trust that ladders out the assets to them over a period of time. Again, that is a will with a contingent trust. A pour-over will or a marital property agreement. This pour-over will basically says everything that's not in the trust belongs in the trust. A marital property agreement is a super important document, and there's a lot of tax ramifications to this, and so on. And so, for example, if my wife wasn't with me when I bought my vehicle at the dealership, I might have just put the vehicle in my name. Well, if something happened to me, my wife can take the marital property agreement along with the death certificate into the DMV and change the ownership of the vehicle from her. It says what's his is hers and hers is his. It's got those sort of ramifications. Now, there are also tax things that are involved. Meaning, let's say back in the 70s, maybe you and your spouse together, you bought a piece of land. Okay, and maybe you paid $100,000 for that land, and today it's worth $200,000. If you were to sell it today, you would be subject to $100,000 of capital gains. Now, if one of you passes away and the survivor was to sell it, and this was a property that you owned a long time, it's entirely possible that you would only get what's called a 50% step up in basis, meaning if the survivor sold it, they would only have to pay taxes not on 100,000 but on 50. However, if you have this marital property agreement and it says what's his is hers and hers is his, and one of you passes away, the survivor could sell that property for $200,000 and pay zero capital gains. 100% step up in basis just because you had this document. Very important. Consider that. Another document is a revocable living trust, which we just spent a few minutes talking about. A document that used to be used in the past, not so much anymore, is the Living Credit Shelter Trust, because it gets into estate taxes, and estate taxes start around $11 million. But then there's also a Q-tip trust, or a qualified terminal interest property trust, and it's a way for you to own, to control assets after you pass away, and so on. And so here's a handful of different documents. You might need just one of these, you might need two of them, you might need all of them. Every family needs something just a little bit different, and so that's what makes estate planning a little bit complicated, is the fact that if everyone should have the same thing, we'd all have this done. The fact is, every family's got different situations, and sitting down with someone unbiased that can give you the opinions on what are the proper documents for you to have is can be crucial and can be very, very helpful. Taxes. I'm going to jump now into taxes. Here's the new tax form. I thought it was kind of cute. It's called the 1040 EZ, and this is basically how much money did you make last year, and send it to us. Does it feel like that sometimes when you're getting your taxes done, that they just want it all? Well, can I tell you that taxes get to be complicated, and the basics of taxes is there's different types of taxes. There's gift taxes, there's estate taxes, there's capital gains taxes, generation skipping taxes, lots of different taxes. But gifting is a tax that applies to transfers that you make during your life. In 2020, you're allowed to give $15,000 to anybody without gift tax ramifications. However, be careful, because if you give someone $15,000 and you buy them a birthday present, technically you just went over the $15,000, and we should be looking into gift tax returns and so on. Gifting allows you, like I said, to see what the recipient does with it, but it also shows you what they do with it. Again, there's plus and minuses there, and it does get out of your estate and removes future appreciation and so on. But can I tell you that gifting also has some cost basis or some tax ramifications to it? Meaning, if I buy a stock for $1,000 and it grows to $10,000, if I sell it, I'd have to pay capital gains on $9,000. Okay, if I gift that stock to my son, for example, and he was to sell it, he inherits that $1,000 cost basis. So if he sold it for $10,000, he would have to pay capital gains on the $9,000 of capital gains. All right, so maybe it would make sense for him to inherit that, because if he inherited it, he could sell it for $10,000 and pay zero taxes. You see, this is something you have to be careful of. Also, take a look at if you've got losses. I mean, if you invest $20,000 in investment and today it's worth $10,000, all right? If you sell it, you might be able to use those losses as a capital loss on your taxes. And you know, if you wait 31 days and buy it back, you'd be able to utilize those losses and some tax and so on. But if you pass away with that, you might lose that loss. Now, this may make sense to be something that you could gift to an heir or to someone, and they would inherit the $20,000 basis. So basically, they would have get 10 grand that would have $10,000 more of growth tax-free to them. So you just have to be careful when you're gifting. Is an important decision, and what you gift can be equally important. Now, estate taxes. Getting into estate taxes, that starts into where in 2020 the dollar amount starts at $11.58 million. That amount changes every year and so on, and that is set to sunset in 2025. It became portable, so if you're married, we're looking at $23 million before we end up with gift or estate taxes and so on. And I also noticed that the state of Wisconsin actually eliminated estate tax. Now, you got to be careful with this, and what I mean is the national debt is pretty big. In fact, it's getting bigger every moment. And one of the things that I've seen is that the government is really good at raising revenue. And who are the easiest people to get money from the government's perspective? Well, that would be rich people. And who are the rich people that complain the least? Dead rich people. So estate taxes are a natural fit for the government in ways of raising revenue, and I see that probably becoming a bigger deal in the future and so on. But for now, this is a political football that the Republicans and Democrats seem to throw back and forth. And so you just have to be aware that it changes a lot. Now, I know you can't see these numbers, but the estate tax exemption changes a lot and so on. That back in 2011 through 2017, it went from 4 or 5 million and so on, and then it doubled. The exemption doubled in 2017 and 18, and it rises, and then it drops back down and so on. So my whole point of showing you this is the fact that it's changing all of the time. Every year, in fact, the numbers change, and it can be a very politically dominated thing. And so you just have to pay particular attention to what things are happening now and currently and so on. Now, there was the Tax Cut and Jobs Act that was signed in December of 2017. And it was the largest tax code overhaul in 30 years. And some of the basics of what happened was some of the tax brackets changed. Meaning the 10% bracket stayed the same, but the 15% bracket turned to 12%. The 25% bracket turned to 22%. Some of the 28 and so on became 24, and the brackets have changed a little bit. And this is what most people think of when they think of the taxes in the United States. And that is that it's a progressive system, meaning they get a little bit for free, and then some gets taxed at 10%, 12, 22, 24. The higher your income goes, the bigger the percentage. Everybody follows that, and in fact, looking at under 150,000, you can see some of it is free. Those are called deductions. Some of it gets taxed at 10%, goes to 12%, and then it jumps to 22%, and so on. Most everybody is familiar with this, and so on. But understand that capital gains, long-term capital gains, have a different set of brackets. Some of it is 0. Some of it is 15%, and then it goes to 20%. And so different assets can get taxed different ways at different percentages. And in fact, Social Security taxation is based on a calculation called a provisional income. Now, this provisional income, how it's calculated is they take 50% of your Social Security plus any ordinary income that you have, which includes money that you either earned or that came out of a retirement account, for example, more than likely, dividends and capital gains, and non-taxable interest. Isn't that interesting? You were sold a municipal bond possibly and said it was tax-free. Well, maybe, but is it if it's actually used in the calculation to determine how much of your Social Security is taxable? And so here's the thing, is that there are different thresholds and so on when it comes to the taxation of Social Security. But when you take the combination of earned income or ordinary income taxes and combine them with capital gains taxes and combine that with the taxation of Social Security, and this is the real tax system possibly for you. And how the system works is you do get some for free, not as much as you think, and then it jumps to 18.5%, and then 22% when you add these together, and then it's possible. Notice here we have a spike at 49.95% in that if you're married in that $40,000 to $50,000 range. And that is a possible combination of ordinary income taxes. Added to that could be capital gains taxes, long-term capital gains, along with the taxation of your Social Security. There's a big spike at possibly. It's possible taking $1,000 out of an investment account could cost you almost $500 in taxes if you're not careful. And in fact, then you can see it goes to 22% and so on. Every family's tax map looks different. And can I tell you, who's the best person to help you figure this out? most people think their CPA or their accountant. And can I tell you that that's not necessarily the best to help you figure out, because their job is very complicated. I call them historians for the IRS. Basically, their job is to take numbers and put them in boxes for what you did the previous year. Very few tax preparers are very good at tax planning. And so that's why you may not have understood how this works. And I do a lot of tax planning, and our firm does. And what's interesting is we have a lot of people that might be living at this level of income, but paying taxes down here or even down to here. And so here's the thing, is that understanding income taxes is a very, very important thing. And it's one of the biggest fees you're ever going to pay in your life. And so looking at how taxes really work, and each family can be a little bit different, and every year it can change, and so on. And so I'm going to skip through the calculation of the 49%, and we can show that to you if you want to come in, and so on. But the keys for tax control is to have different types of taxable accounts. You might have some IRAs or retirement accounts that are all taxable. You might have some Roth IRAs or Roth conversions that are tax-free. Maybe you've got investments that are non-taxed as they grow, or after because you pay taxes on them every year. Maybe you've got tax-deferred investments and so on. Properly blending the withdrawals of your investments throughout your retirement is hugely important. And structuring your income and figuring out where is the best place to get these assets from to make sure that you are living at one level and paying taxes at another. Knowledge is key. And I can't overemphasize this enough, because you have different time frames. You have, let's say, prior to age 62. Then you might have a different set of tax consequences between age 62 and 65, because we have to deal with health care and health insurance and making sure our income stays at certain levels so that we don't lose our credits. And then, of course, we have to go from, let's say, 65 until 72, because at 72 we have to deal with some tax issues with retirement accounts. And so we have different time frames at different stages in our life. And so this is something that is so important to be looked at on an annual basis. The more often that it's looked at, the more you can save. Because here's what I've found. When you're dealing with taxes, there's two ways of dealing with it. You keep it simple and just continue to overpay, or you get a little complicated and maybe you can save a lot of money. And having a good tax advisor is so important, especially in today's tax complexities and tax laws. And in fact, the laws are changing all of the time. In December 20th, 2019, the Secure Act was changed. And this is a game changer in regards to changing the age of when Social Security is, when required minimum distributions have changed. It used to be 70.5, now it's 72. And when you inherit money and so on, how to handle retirement accounts and so on, a ton of changes. And income taxes at retirement is hugely important, and we're dealing with Roth IRAs and IRAs. But one of the things a lot of you are familiar or may not be familiar with is that there are certain ages that things become important. Meaning, the number used to be age 70.5, and now it's 72. By April 1st in the year after you turn 72, you're required to make what's called a required minimum distribution. Now, this required minimum distribution is extremely important, because if you forget to take that RMD, that required minimum distribution, the penalty for forgetting is possibly 50%. So if your required minimum distribution was $20,000 and you forgot to take it out, the penalty for forgetting could be $10,000. And so be careful with this, and it is so important, and those laws have changed. In fact, one of the things that's just changed is the CARES Act. The CARES Act actually eliminates required minimum distributions for the entire year of 2020, but 2021, things change back. And so understanding the laws used to be 70.5, now they're 72, but one of the things that did stay at 70.5 is what's called qualified charitable distributions. You see, if you're over 70.5 and you give money to a charity, okay, in the past, many of you used to itemize on your income taxes, and itemizing was actually fairly common. But in the tax law changes that have happened in the last couple of years and the doubling of the standard deduction, what's happened is that we went from a good percentage of the population to almost very few people, almost none, very few, only 5% of the population, don't quote me on that, but a very small percentage of the population actually itemize their income taxes anymore. And so what you used to be getting deductions for, you may not anymore. And so if you're over 70 and a half, one of the things that we recommend possibly is looking at qualified charitable distributions. And these, what are called QCDs, is a way of taking tax preference dollars or pre-tax retirement dollars, for example, and going straight to a charity. Basically, it can be used to satisfy your required minimum distributions after age 72 especially, and yet fulfill your charitable intent. And the charity then doesn't pay taxes on that because they're a charity. And so understanding, now don't do any of this tax stuff that I'm talking about without proper tax guidance and talking to tax advisors and so on. It's so important to understand that these things are changing, and they change a lot. In fact, one of the things to understand is that death, what happens to your retirement accounts? You know, I've read articles that talk about nationwide as an average, over 90% of your retirement accounts, IRAs and so on, at your death just get cashed in by your heirs. Now, this is an important thing to understand because that might not be the best thing to do. There is a difference between inheriting an IRA and an inherited IRA. You see, if upon your passing, if instead of your heirs just cashing out the account, maybe it makes sense for them to place it into an inherited IRA. And this inherited IRA allows them to not have to pay the tax all up front. It allows them to split the tax, let's say, over 10 years. And maybe they don't want to split it evenly over 10 years. Maybe they want to take it all out in year 4 for whatever reason. Or maybe they want to wait 10 years and take it all out then. It's possible to do. But why are people still just cashing it in when they don't understand that? And that's because most people work with investment advisors. Now, investment advisors may be calling themselves financial advisors, and many of you have financial advisors, but can I tell you that if your financial advisor hasn't looked at your taxes in the last 3 years, they're not a financial advisor in my opinion, they're an investment person. And that investment person might be charging you financial advisor type level fees, and you're just getting investment advice. And so my point is that if you're going to pay fees to an advisor, that's a good thing, that's an okay thing to do, but make sure that you're getting comprehensive financial advice addressing all of these things, that they aren't just simply an investment person. So you have to be careful with this. And so understanding how Roth IRAs work, understanding required minimum distributions, are qualified charitable distributions something that you should deal with? Understanding that the laws changed in 2017, they changed again in 2019, they've changed again in 2020. It's a constantly changing thing. And understanding the updates and the things that are changing, it is so important because like I said, you can either keep your taxes simple and overpay, or you can get complicated possibly and save a lot of money. Family tax bracket management, because of these changes, has become more important than ever. Meaning, if you are in a very low tax bracket and your heirs are in a high tax bracket, maybe it makes sense for you to take money out of your retirement accounts even if you don't need it. Now, be careful, but if you don't need it, maybe it makes sense to do a Roth conversion. Maybe not. Again, calculations need to be made. But the opposite can also be taken into consideration, that if you're in a very high tax bracket and your heirs are in a low tax bracket, maybe it makes sense to just defer as long as you can and let your heirs pay the taxes. You see, family tax bracket management is critical, and so on. So that's something that your accountants usually don't address, and it's a lot of times your so-called financial advisors aren't addressing this, but it is important to understand what bracket you're in and what bracket your heirs are in. Now, I'm going to shift gears and talk about nursing homes and long-term care. The government program that pays for you to, provides care for and pays for you to stay in a nursing home is Medicaid, not Medicare. This is a big misconception. People think Medicare pays for their nursing home. It does not. With an asterisk, that Medicare can pay up to 100 days if you've come from a hospital and you're rehabbing, and there's a whole series of rules. And really 100 days in the nursing home, yes, it's expensive, but that isn't the biggest risk to your finances. That would be a long-term stay. So the government program that pays for a long-term stay for you in a nursing home is Medicaid. Medicaid is a needs-based program, meaning you have to financially qualify. And I know these numbers are hard to read, but these, if you're married, a non-hospitalized spouse is allowed to have a house up to $800 and some thousand in value, 128,000 plus of investments. Again, these numbers change every year. A vehicle, clothing and personal belongings, a certain monthly income, a vault and casket trust, life insurance, a little bit of life insurance, and a little bit of cash. If you are above any one of those categories, you will not qualify for Medicaid. And so one of the interesting things that I've seen over the years is that people say, well, the nursing home took, grandma's farm, or the nursing home took Aunt Betty's stuff, and the nursing home didn't take anything. Here's the thing to understand. The nursing home doesn't take it. The nursing home provides you care and gives you a bill for $8,000 a month or whatever the amount is. And you have to pay it. And you're required to pay it until you financially qualify for Medicaid. And so understanding that. Now, this is if you're married. If you're not married, they don't allow you to have a house. If you're deemed you're going to be in the nursing home for more than 6 months and everything else is gone, you may be forced to liquidate your house. They don't let you have these investments or a vehicle. They do let you have clothing and personal belongings, a vault and casket trust and so on. But basically, if you're single, they don't allow any of this stuff. And so what do? Nursing home exposure to risk is a huge, huge problem. And one of the things that ways that we've seen people handle it is through nursing home insurance. And of course, that whole industry is changing quite a bit. But one of the issues that I've seen in the past with nursing home insurance is that nursing home insurance is sold by insurance agents who get paid a commission, and largely the higher the commission, the higher premium, or the higher the premium, the higher the commission, and so on. And you can see that this can be a little bit of a problem. And the way that we deal with it in our firm is we look at people having basically 3 different levels of finances. We have people that we meet that have low enough finances that if they did go into a nursing home, there wouldn't be a huge financial burden, and Medicaid would take place and so on. Then we have people that have high enough assets that can afford that $8,000 a month. And that might be, let's say, $1.2 to $1.5 million of liquid assets up and above their maybe pensions and Social Securities. And that would qualify where basically they've self-insured. But then there's everybody else in between. And where you fall in between can dictate the type of policy that you should have. Meaning, if you are closer to the bottom of that level, then you might need to have a much bigger or a larger valued policy to protect your assets than someone up here closer to the top, you see? And so to calculate out the proper amount of long-term care insurance that one should have is you need to disclose to someone who's trying to sell you something how much you have in assets. And I don't know about you, but the last person I want to tell that I have a large sum of money in my checking account is someone who's trying to sell me something. And so that's why the proper calculation for long-term care is to sit down with someone that you trust that can look at the big picture, that can look at all of these different things and where you fall and understand your net worth and understand your income and where that all comes from and so on. I can't overemphasize how important it is. Now, one of the things that I've seen people do is they start gifting assets. Well, the look back period from a nursing home perspective currently is 60 months. I remember back when it was 24 months, and then it went to 30 and 36 and 48, and now it's 60 months or 5 years is the look back period. And basically when you apply for Medicaid, they say, have you given any money away in the last 5 years? And so one of the things that I've seen people do is they go through and let's say mom and dad gift their house to their kids. Well, when they did that, that did maybe start the clock ticking for that 5 years that when they go into a nursing home, they can say, yeah, we gifted the house and we protect, more than 5 years ago, so we don't have to count that. But the kids inherited the cost basis on that house. Keep that in mind. And two, they might have too many other assets in different areas that they wouldn't have qualified for Medicaid anyway. And so some people go and they gift their house. Their kids are the owners of the house. They go into a nursing home, ended up not getting any Medicaid in the first place, and then when they pass away, their heirs go and sell the house and they have to pay capital gains based on what their parents paid for the house because it was gifted to them instead of them inheriting it. My whole point, this is a complicated, big issue, and it's a complicated area. And really, you need to be really careful who you talk to about this stuff because you need to figure out the right things and the right amounts and so on. So nursing home is a very passionate, emotional topic, and every single one of you has a different situation. So it's so important to talk to a professional like us that helps look at the big picture and can truly understand your exposures to risk in this area. Now here's the thing, is I've been doing these meetings, like I said, 4 or 5 times a year for many, many years. And over the years, I've seen a lot of things. And last year we had 14 clients pass away. And the year before that we had 12. And can I tell you, I do my best. Clients that have been clients, we become friends. And I go to as many of these wakes and funerals as I can. And that these wakes have some very similar things at them. There may be a casket, maybe not, maybe a line of people down the row and talking to the family. There may be a PowerPoint presentation, and every once in a while a funny picture comes up and people giggle and so on. But can I tell you that when you're sitting in the back of and I'm sitting there with, let's say, the 2 kids, and when one of the kids says to the other ones, I am so glad that mom and dad took the time to organize everything and take care of all of their estate planning things so that we don't have a mess. That's a different feeling than when I'm sitting there and one of the kids look at the other one and says, I cannot believe the mess they left us. Now, it doesn't change the feelings of the day. It doesn't change the PowerPoint and all those life memories, but it is the last taste that gets left in your heirs' mouths. And so just be real careful with this and understand that estate planning is important. And when should you evaluate your estate plan? We recommend at least once a year. Tax time is a good time to do that because you usually have your tax documents out. After a substantial gain or loss in an asset class, if your household changes, if you get married, divorced, become widowed, change jobs, inherit assets, receive lump sum distribution, these are all different times that you should have your estate plan evaluated. And I'm assuming that if you're still watching this video, that you don't have it done that often, because if you did, you wouldn't be probably sitting through this. Now, here's the thing, is we talked about a lot of different things, and I know this video is free, and so I hope you received some value from this meeting. And so one of the things that I want you to think about is a physical. And what I mean by that, have you ever been to the doctor for a physical? What was the idea behind the physical? That was, am I healthy or not? And what can I do to become healthier? And the doc gives you ideas on ways to become healthier. And then what did you get in the mail? A bill. Well, at least I have. Every time I've been to the doctor, I seem to get a bill. Now, the question that I have for you, when is the last time you had a financial physical? And what this financial physical is a way that we sit down and go through your stuff, and you basically let us know what is it that you want to have happen if something happens to you, and then we would take a look and see, is that something that would actually happen? So here's what we're offering, is an absolutely free, no obligation consultation to sit down with either myself or someone in my firm, and we sit down and go through those things. And in doing this, we will do as much as we can in 90 minutes or less. And if we need more than 90 minutes and need to schedule a second meeting, that still can be free also, and so on. And in doing this, we understand that there's a lot of complexities, and in fact, I mentioned several times today the idea of being organized. And so in going through that, if you come through and meet with us and so on, we will share with you an organizer, and we've got different types of organizers, so we will help you become organized and so on. And I also mentioned the idea of attorneys being involved with creation of some of these estate documents, and we have local attorneys that we work with that we can refer you to and so on. So here's the thing, is the advantages of going through this absolutely free financial physical that you can receive is that we may be able to help you handle your estate in the height of efficiency. You can properly decide who's going to receive your assets. You can decide who's going to manage your estate. You can possibly reduce estate taxes and reduce administrative expenses by maybe avoiding probate and so on. We will save you money in taxes. Almost everybody that we meet is overpaying taxes in some way, shape, or form, and one of the things that we get a kick out of is sharing with you ways to save you money in taxes. We found if we save you $1,000 in taxes, we become friends quicker, so we spend a lot of time with that. Selecting proper guardianship for your children or heirs or people or the people that you're responsible for, and providing for orderly continuance or sale of your family business is advantages that you receive. Now, basically this is done in 3 easy steps. 1, watch this video and so on. You just went through the hardest part of this whole thing. 2, come in for a free personal consultation. And to do that, we have to give you a list of things to bring into that meeting. And so you should contact us, and we can send you a kit that will give you a list of things that we recommend that you bring to this meeting, and so on. And then in going through that, the meeting's absolutely free, and in going through that, then you just apply the techniques learned. And so here's the thing, is our mission here at Hasenberg Financial Group is to provide you with financial guidance to help you enjoy life more and worry less. And if we've done that, then we are definitely accomplishing our mission, and you can maybe feel like these people going down the highway with enjoying life more and worrying less. So, disclaimer, our securities are offered through Royal Alliance, our broker-dealer, and Royal Alliance is part of the advisor group, and they're a member of FINRA and SIPC and so on. And I want to thank you so much for taking some time out of your schedule to watch this, and don't keep us a stranger. Tell others about us, and tell others to go to our website, www.chrishasenberg.com, and watch this video. The more people that see this information, the more people we can help. So be well and have a great day.